So Farouk, we're doing this session because you're asking about the dollar costing in, yeah.
Yep.
So we're gonna have a conversation about it. Now let me just do this here. There we go. There we go. Okay, so now here's the screen I want to share. And again, Farouk, is it a reversal or not? Are we going up, or is this puppy going to turn down?
Just a nightmare.
I know, I know, I know.
Yeah.
But that's the name of the game at the moment, isn't it? Sort of.
Yeah. Yeah.
So much.
Luckily, I'm not trading with big money so far. It's just like a little bit right now, but it's just ridiculous.
It is, yeah. But you know, I tell you,
Yeah.
it's a great time to test the TA and the strategy, and as long as the money is the risk management is there and the money's low, it can be a bit of fun playing this, you know. And you learn a lot. Like this is for me, this is like a quagmire. Is with regards all the MAs. All the MAs are so intertwined and pushing and pulling that it's just flipping and flopping. You know, you get like 1 6 10 hour period, and it's, oh my god, look how bullish that is, and then it flicks, and then the next 10 hours, Jesus, look how bearish that is. So it's not very often you get to see the indicators being so untrustworthy. Essentially, is like I'm looking at a bearish divergence all the way up to the 1 hour here, which is a clear sign that it's going to turn. But too many times lately, I've seen bearish divergence invalidate. You know. So I don't know. We'll see how it goes. So the conversation I want to have is about dollar costing in, and I've done a couple of sessions on this, and I'll need to do more because there's so much to it. There's so much to it in the sense of I can say it easy enough, but when you're in the trade and you're under the pressure of the trade, is staying adaptable with your DCA. There are more options than you would think. So let's start off with the basic idea, and then as we talk through it, I'm going to give you some other options of how you can DCA. And I'll give you an example. Is let's say my price action is at 90, whatever it is, 90, yeah, and I want to DCA in and pull my entry point to 95, so go up 5 points. So one of the things I could do is, and let's say I'm a little bit in the green or a little bit in the red. I'm $10 in the green, $10 in the red. So it's not big money either way. Would that be right? Yeah, no, it wouldn't be right. My correction. My correction there is if I want to move, let me write it here. My price action is here. My entry is here. Look, I'm being stupid now. So just because I started with my entry is here, price action is here, I want to bring my entry point up to here. I'm just trying to give you an example of something you could do, yeah? So, I'm a little bit in the red, okay? And I'm willing to take a little bit of a loss to change my price action. One of the things I can do is I could put money in my DCA, okay? And here's my entry. I could put money in my DCA, and it will pull my entry point up to here. Okay, so now I pull my entry point up to here. Now let's say I'm $100 in the red. So my entry point, price action, I'm in the red $100, is I could put money in my DCA and bring my entry point to here. And let's say I put in $100 and I've doubled it. So it pulls my entry to halfway between my entry point and price action. So my entry point, where price action is now, and I'm going to put in $100, and that's going to pull my entry point back to here. So it's halfway, it's bringing me halfway back, yeah? And if I put $100 in, let's say, and again, I'm making this story up, I'm trying to give you an example of what I could do, is let's say that I am $40 in the red. So entry point, price action, $40 in the red, and I want to bring my entry point up to halfway between. So what I can do is, I'm $100 in, I could put another $100 in my DCA, and it will pull my entry point to halfway between entry and price action. Okay, so I could do that, and then what I can do is I can leave the money in if I want, or what I can do is I can take back out the $100. I can take this out. I can cut 50%, do a 50% loss. What would happen is I would take out my $100, and as I did that, I would also lose $20. So I'm in the red for $40 here, okay? But I want to move my entry point back so that when price action comes back, I'm in the green quicker, sooner, okay? So I put in $100, pulls my entry point back to here. I immediately take that $100 back out. And as I do, I'm reducing my trade by 50%. So I would lose, I would be letting go of, I'd be losing $20 because I was $40 in the red. So now what have I got? What's the benefit of that? Is I bring my price action halfway to meet my entry point halfway to meet my price action. So I'm benefiting from this. Is I'm losing $20, but when price action comes back, is I will be benefiting by making more than $20 when price action moves this way, because I'll make the $20 back plus more by the time it gets here, but equally as price action moves, is I start to make more. So what I'm trying to say is it costs me $20 to bring my price action back, but then I reduce my risk by taking the $100 back out. So I've moved my entry point, I've taken a loss of $20, but by the time price action starts to come back, is I am making my $20 back plus more, and then as it continues on, again, I'm making plus more again. So I get my $20 back, but what I got from that is I got a much better entry point. And then I've taken the money out that I put in, so I'm also managing my risk. And what I mean by that is that, let's say price action decided to go this way. Well, I still have my initial $100 in, I don't have $200 in. So now it's cost me $20 to move my entry point. That's a simple way of describing it. $20 to move my entry point, more than $20 as it comes back. And when I take my $100 out, I'm still managing my risk. I'm still in the same risk management. So really what I'm trying to say is, in a roundabout way, is that I've moved my entry point and it cost me $20. And then I'll make it back plus more. So that's one of the examples of how you can use your dollar costing in. is to move your entry point, take a bit of a loss, take out the risk that you put in, and then benefit from the new entry point when it turns back. So it's actually very flexible. Sometimes I use it because I can see the benefit of doing it. Another one is what was the other one I wanted to show you? I had another one there. Bear with me for a sec. What was the other one I wanted to show you? It'll come to me. It'll come to me. It'll come back to me. So there are a number of things that you can do that are very, very flexible. You'd be surprised that sometimes you take a small loss up front, but it changes your position. Okay. So now let's get into the basics of dollar costing and when to go in and when to dollar cost out. Okay. And here is the 15-minute. Here is the support line. Here's the resistance line of this part of the arc. Yeah. So let's name the trades. There's a long. Here's a short, a long, a short, a long, a short, a long, a short. 1, 2, 3. Let's exclude that one. 4, 5, 6. So let's say there's 6 where it goes top to bottom. Okay. So now where we are on this one, by the way, where we are on this one is it's what I believe is possible is that we went on a short, it got down nearly all the way, came back up, and then we're looking to head back down again. So that's what I think potentially here is we went on a short, actually went on a short, came down, a retrace back up, and then we're looking for it to come back down again. That's the plan for that trade. Yeah. Okay, so now let's have a look. We go in somewhere here. Okay. Actually, no. On this trade, we'd be coming in from a breakout. So we'd be going in this range here. We look to catch the breakout, and again we're following it up. So we're already in a trade here, yeah. So where are the natural points? Is let's say we hopped in on the trade here, okay, and it goes up, and okay, it confirms itself as a breakout. So once it confirms itself as a breakout, this here this will be a good place to dollar cost in, because here it is breaking the previous triangle. There's a back test here. It breaks up, it goes sideways, it goes up again. Solid confirmation. It'll pull your entry point up a little bit, but there's a dollar cost. It spikes up, okay, does a retrace, it drops back, it heads back up. Here could be a place to do a dollar cost. But again, it goes sideways again, goes sideways again. Sometimes it comes up and comes down, it goes back up, it could even come back down again. So sometimes, yeah, we'll talk it through. So there's a potential dollar cost. Again, it goes sideways down, okay, we're going to wait. Okay, look, now it's traveling up. Here's another one. You don't have to do them all. I'm just pointing out when you're looking at price action and how it's moving, the potential places we're looking for. And what we're looking for is sideways, consolidation, there's a breakout. So consolidation, the pump after it. Is a retrace, the pump after it. It does a bit of this, okay, sideways. We want to make sure that it's going up again. So look, there's the break. It's breaking this, it's pumping. There's another opportunity. Then it's doing this sideways, gradually finding its way up. Is again possibly here, but let's not. is possibly here, but let's not. I would suggest that here is one, because again, now it's starting to push up, or it retraces, and here. One of these. Okay? And the reason being, we're looking for consolidation and a break, or a retrace and a breakup. They're the two basic ones, yeah? Now we're also following up the fib to check how far is this going to go. How far is this going to go? And we're following the mapping, okay? And what I mean by that is we're looking at the potential here of the 1618. So again, this is where we're looking at the general target. If it runs short, it could be the 414. If it wants to go on more, 786, even the 272. But the 1618 is the general target. Okay, so we're still traveling up. It gets up to here. Here's 3. Okay, now this is where it gets interesting. It retraces all the way back down. So now look, one of our DCAs is it's after spilling back to it. 1 or 2, yeah. So we're here. We've DCA'd 1, 2, 3, 4, 5. Let's say we've done at least 2 of them or 3 of them. If you started here with your entry point, okay, by the time you've DCA'd in 3 times, you're probably looking at your entry point maybe around here. Okay, now I think I'm exaggerating a little bit because it's halfway between here and there. So that if you put 100 in here and 100 in there, it'll bring you up to here. So because you're putting 100% in. But if you put 100 in here, and you've already 200 in, it won't bring you up another 50%. So this one will bring you to here. You put another 100 in here, it might bring you to there. It'll only bring you to a quarter of between where you are and the space in between. It'll bring you up a quarter, won't even bring you up a half, because you're only putting 100 in on top of 200. Okay, so by the time you put, say, another 100 in here, or maybe 200, you know, is your entry point will be getting pulled up to around here. So here I'm actually giving a bit more to it. So by the time you've got up to here, your entry point is here. So you're well away, yeah. But it comes back here. It comes back and you go, okay, this is the challenge here now. Is this 5 or is this 3, 4, 5? Well, you got to let it come back and do its thing. Okay, and then you want to see, now it's turning around and it's heading back up. Maybe you go, I think I'll be a little bit more patient because I've already DCA'd in here or here, one of them. So then what do? Is, okay, there's the first pump, and then a bit of a retrace. When it goes again, there you go. There's a space for you to go in. Is it comes up. Okay, now at this point, is you can be pretty sure that that price action is heading back up to the top, and possibly it's going to head back up and do a 3, a 4, or a 5. Okay, so now here is maybe your final DCA, and you're looking to, when price action starts to get back up around here, again, you're looking to take profit. So maybe it's here, you see it topping out, you go, listen, I think that's good enough for me. You see it retracing again, listen, I'm going to take my profit. You might go, no, I think this is an absolute 3, 4, 5. So what I'll do is I'll wait. So it retraces, consolidates, pumps again. Eventually, you can see, look, it's going to break the top here. And as it breaks the top, is, again, you're taking your profit. Is maybe it's got more to it, or maybe this is it. So any time from, say, there on up, is you're looking to take your profit. Whether you take it here, whether you're patient and take it here, you know, and you want to see, this is a 3, 4, 5, so you want to see where it's going to go, is maybe you'll see it, you retrace, you're still going to take it somewhere around here. So that's a way to do it, is you don't have to dollar cost in all of them, but you're just looking for your opportunities. You might come back to here and you go, look, this all the way up here, and you go, look, it's coming back here, and you're thinking, Jesus, this might go all the way down. What you can do is you can take a portion out. You can take 50% of the profit here. And you go, look, I'm going to take 50% regardless. Okay, don't like the look of this. I'm going to take 50%. It comes here. Okay, starts to retrace up again. Oh, look, it's going up again. I'll put some more in. So you can dollar cost in again, and again, you can follow the trade up and look to take your profits again. So you can dollar cost on the way up to add. You can also dollar cost out. So you're adding to the margin to make a greater profit. Equally, you can take from the margin where you're taking profit, especially if you don't like the look of it. You go, I'm going to take out 50%. But if it turns and goes up, sure, I can add in again. There's nothing to stop me putting more money in and again building the profit for here again. So it's very, very flexible. It's very adaptable. Now this is on the 15-minute, so there's more space to move through to do this. So you can look at all these points, and there's lots of opportunities to DCA in. When you're doing it on the 5-minute or on a tighter space, which this is, like it took all the way over here before this started to come down. So this sideways action here is a smaller space. It's harder to, the way I DCA there, it's harder to put in as many DCAs here. You don't have as many opportunities. So you got to manage that. So look, you hit your take profit, okay? So now we got to set the lines. You got to set the lines. So the support and resistance is this one here. If you ignore all of this, you see it coming down. You go in on your short, okay? So somewhere along here you go in on your short, and again you bring your stop loss or your liquidation price up above skyline, and sure, price action isn't going to get up there. So you're going on your short. Is 1, 2, 3, right through 4. Is, I think you could set this line pretty early on. Is probably, this is the one that I would use as the marker, and this one. So this here and that there gives me a good idea of the resistance line. These will help support it as I confirm it as I go along. So now, how do I confirm this line? Again, this is where this gets a bit challenging. You're in your short, and we're exploring where price action is going to retrace to. So now the challenge with this one is that it brought in, this is bull volume. So you got the bull, you got the bigger volume coming in here, but then you have the bull volume still pushing, so the retrace here is not the bear retrace. Like we were getting deeper retraces in the bear channel, much deeper, because the trend overall was down. But now the trend here overall is up. So it makes it really tight. So this is not the easiest to get a sense of how to confirm this line. Okay? This gives you a really good idea, but you have to get there. Okay? And it retracing up here is a good confirmation. So now here's your short. Okay? Here's your short. Here is the impulse down. So look, there's the push down, there's the 1. It retraces back to 2. So here's your entry point, retraces back, starts to head down. Once you see it starting to head down, there's another DCA point, because you know then you're going to get the push away. So here's a push away, it retraces back up, and it pushes away again. Now, if you want it to be really tight with your DCA here, rather than going in here, wait until price action gets below this point. And you can say there's a DCA point there. Okay, so remember, is $100, your entry point is now here. Another $100, your entry point is about here. Okay, but here's price action. It comes down, look, it hits a bottom, it retraces back up, and again, is when you see it moving away, here's an entry point for your DCA as well. Okay. Now this is where it gets challenging. Is I'm going to put the fib on this. There's the top. There's the bottom. So there's the top. There's the bottom. All this sideways action here, look, came all the way down. It eventually came all the way down to the 786. Look at it hitting off the golden pocket here multiple times. Okay, but here it only came down as far as didn't even get down as far as the 05. So again, this here is difficult to read. For sure, it's difficult to read. It's breaking the expectations of the bear retraces where they go deeper. So now, how do you do this? You gotta live in the trade, so to speak. Is you gotta go with it. So you're getting your 1, 2, your push away. Here's your W, your 3 scoops. 3, 4, 5. So you can find an impulse in it. But then equally is you got the impulse. Now look at the bounces here. 1, 2, 3, 4, 5, 6. And then look at these two here, this one and that one. Now look at this here. So you can easily just put a line here and you go, look, there's a support line. It's a local support line. Now there's something else you can do is you can zoom out. You can zoom out and check. Has it been a support line before? Yes. There, spot on there. Support and resistance along here. Support, resistance. There you go. So you'd be mindful that this area is an area where it could drop to. Okay, and this is confirming it. So look at how many times you've got your entry, 1, 2, 3, you're DCAing here. If you're not sure about this, it comes down. When you start to see it retrace up, again, you're taking your profit. You're taking your profit, yeah. Again, this is a challenge, is if you took your profit early enough here and then you see the retrace, is you can go in and get your entry point here. If you don't, let's say you waited until you got this retrace, you go, okay, I'll take my profit on my short, out I come, you know, then the question is that you've got your support and your resistance here. Do you go in on a long here when you know you sort of missed the boat a little bit, is it's already well traveling up, is you're moving in a tight space, is do you wait and watch it? And what I mean by that, do you wait and watch, and again, catch the bus? So what do I mean by catching the bus? Is you wait until it comes back to either the support or the resistance. Okay? So now let's say we say, okay, we missed the bus, is we'll wait. So we'll wait, now it hits up here again. Okay, so now you've got your entry point. There's your entry point. Okay, and look, comes down, does a retrace, and then moves away again. There's another DCA moment. It comes down, and to be honest, this is a tight space, is you're taking profit here. Okay, it's a nice, reasonably quick trade. Is, again, let's say you're going in your entry point here, but this time it comes up and comes back down and breaks the green line. But again, your stop loss is down here somewhere. Okay, it's down here. You know, how far would you be looking to bring it down at some point? Can you bring it all the way down here? That would be the limit of it. And what I mean by that is that where this arc broke out is this would be, if you really needed to, is to bring your stop loss down to here. So if you're putting in big money, there's no way you're going to risk putting your stop loss or your liquidation point down here. There's not a chance you're going to do it. But if you're putting in small money, is you're risking your small money, but you have a lot of space to move your liquidation or your stop loss. Like, that's one of the benefits of it. If you needed to. So look, you got your entry point here. Okay, is it comes up, is it retraces back down. You're in the red for a little bit. It comes up again. And again, one of the things I'd be looking for here is that it's already gone up once. It comes down. It goes up again. I want to see it break this before I go in again. I want to see it break this high. So look, it comes back down again, and then there it is moving up. And again, there's a DCA moment when you break this high. And again, up it goes, and you're hitting your target. Again, you're taking your profit, yeah. So now we're looking at this, and again, we're all asking ourselves, is this going to break up, or are we going to get a proper breakdown? Because, you know, all the way through this, we've been waiting for this. So we're not blind to the fact that this is coming. Okay, so now we go in here, okay, and we pull our stop loss up to here. If it did break out, remember, you're on a small amount. It breaks out and it breaks your stop loss. Okay, you take a hit, but it's on a small amount. Okay, it comes down, and now you're back in the bigger drop. Okay, so now your entry point. There's a spill here. You know, there's a drop and a retrace. Maybe you go in there. You know, spills even more. Retrace. Touch again, retrace, and then down it goes. So now, why would you not take profit here? Well, this is already suggesting that there's a push down, but it came back up. So here it is testing it again, the touch, the release, the touch again, and then the push through. So the MAs here, we're solidly predicting a spill. Okay, so now we decide to follow the spill. So there's a DCA there, maybe not. It comes down again, it retraces, and again, quite possibly, it comes down again, it retraces, and when is a good point at DCA? Is when you can see this line drops, retraces, now it's moving away. There's a DCA point. Now again, this is in hindsight. So it's easier to call it in hindsight. It's quite possible that somewhere within here, we DCA in. It touches, it comes back up, it's coming down again. We could end up DCAing here, thinking it's heading down, retraces, and then goes down again. So it's not a perfect world. You know, sometimes you find yourself DCAing, and then it does a retrace up. You know, that happens. But that's okay. Your entry point is up here. So now here's the drop down. Okay, here's the retrace, And when you see it begin to spill again, there's another DCA. And then down it comes. So now, as it's coming down, especially on the last one, is one of the things I have a tendency to do is load in a little bit more. So look, there's my entry. There's 1, there's 2, there's 3. I see this coming down. I'm thinking, okay, this is the last drop. I'll DCA in here. I'll do it again there. And I'll do it again there. You know, especially if I see it's a bigger drop. Same with here, is when I see it coming closer and closer, is and I see the way of it, the lay of the land, is I have a tendency to DCA in as it's getting up to these higher peaks. I DCA in more. So I'll bring my entry point up more, but that's where I start to load in more because I can see it's really starting to take off. Same with here. So now you've got your measure. Look, it's back to the impulse wave up, and here's the correction down. So we'd be mapping that out and going, where are the potential targets for this? So there's the top, there's the bottom. Is it drops not even to the 0.5, comes back up. Now it starts to come down. What are we looking at here? We're looking at the golden pocket. So we've got the first leg, the second leg to the golden pocket, back up to the 0.5. So we know the third leg is at least going to hit the 7.02, potentially the 7.86. So when you see that go, it's a great time to load in. It's pulling your entry point down and you're loading in. And again, is if it hits here, I'm pretty sure that it's going to break through the 7.02. It might not hit the 7.86, but it's going to get close to it. It actually did. It hit it, yeah. So now again, we're taking our profit. We're taking our profit, and we're going in on the long here. Okay. That's what it is. Look at that nice red candle there for a retrace. Woohoo! There we go. Is again, here's our entry point. You got that lovely pump. It is tempting to DCA in here. You see this retrace here? I would be tempted to go in there. It pumps up here. It retraces back. And I see it coming up like this. And again, I know that it's possible there's going to be a bigger sideways retrace here. If I was impatient, I could jump in here again and then have to go through all this. Or it does its thing and then I start to see it move away. I'm in there. You know, it goes sideways again, starts to break up again. I'm in there. Does another sideways breaking up again. Is again, could be putting in 1 or 2 more here, especially when you see that it's getting that blow off. Is, you know, it's working its way up. Is so from entry point 1, 2, 3, 4, 5, 6. Even if there's only 3 of them, is it's still a good position. Okay, so and again, this is in hindsight. So this is what I'm saying here is that, you know, is, oh yeah, wait till here and go in again. You know, impatience here, well, and it looks, there's a retrace and up it goes. I probably would have gone in here. And what I'm really looking for all the time with an impulse is that when you get the 1, 2 and the push away, is the sooner you get your second one in, the better. And what I mean by that, I put 100 in here, is when I put 100 in here, it's only going to bring me up to halfway between these two. If I wait to put 100 in here, it's going to pull me halfway between these two. So I'm always looking for, when you get the push away, and then there's the retrace, and it starts to go again, I'm in. I want to go in then, because the entry point will be moved a lot less. So I always want to get my second DCA in as soon as I can after my initial entry point. But I'm always looking for the push away, the 1, 2, the push away, and then in it goes. So, and again, here again, see this here, lovely long push away, and here's the retrace. Here's another sweet spot to take, because again, it'll pull my entry point up to here, and then I know it's going to be working away again. So I'm mindful of that as it goes along. So now let's look at an example of well, what happens if it gets a bit messy? And this one here is actually an example of it because of the retraces here, yeah. So let's look, and you go, look, you got in. Let's say you got in a little late, just to make it a little bit more complicated. Okay. You got in here. All right. And then you DCA'd here. Okay. So now your entry point is here. I'm going to change the color. Okay. So you started here. Price action went down. Retrace pumped away, so you went in again, so it pulled you halfway between them. It goes down, turns around, starts to go up. You're like, oh, for Christ's sake, what's going on here? Is going up. Look, now you're in the red. And you've got 200 in. You're in the red. And then it starts to go down again. And you go, okay, now you're back in the green. Down, retraces, goes down again. Okay, I'm going to go in again. Okay, so now I'm gone in again here. I'm nearly practically where this place is. I'm gone in again, drops down. Now this will bring your entry point down to here, say. And you're not 100 in the game, you're 300 in the game. Okay, so you're 300 in the game here. It drops to here, does this consolidation, and then goes back up, and you're like, oh, what the hell's going on here? What the hell's going on here? Oh, now you're in the red again. Okay, so you're in the red, but you're not in the red for 100. You're in the red for 300. So now this starts to eat in. You can feel, you're feeling this more because it's 300, and you're all the way back up here. Okay, past your entry point. So, and even if your dollar cost in here is to get a good pull on your entry point, you'd have to put in the same amount of money again, 300. So you don't want to do that. You don't want to be compounding your risk here. But what can you do? Is, well, let's say you see it coming back up here. Is you're still in the green here. You could take out. You could either take some profits here, by the way. Take some profits here. And then, again, if it breaks down, great. If it doesn't, sure, you've taken some profits. You probably won't, because you're waiting to see. You're waiting for it to do the retrace. And what do I mean by that? Is here's this wave here. Put the fib on it. And we're looking at it coming down to at least the golden pocket. Here's the 702, the 786. Remember, it came down to the 786 last time, so 702 is pretty reasonable. 67.50, that's a reasonable target. But look, it's after coming up here. So what's going on? Excuse me. What's going on? Is one of the potential ideas what's going to go on, or what's going on? If it doesn't break out, if it doesn't break out there, because look at that sweet, look at a sweet inverse head and shoulders there, is the moving averages, they're up and down, they could just as easily break out. But equally is, look at the correction. Look at the correction on here. Is you have the impulse up, is then you have an A, B, and a C. Okay, so now another way to measure this is, here's the B, here's the A. You put from B to A, from B to A, and you come down and you take a measure and you look, the target you're looking for will be the 618 as the general rule. Is it came down and there's the 786, it nearly came all the way to 2272. So that's another way to measure, is the impulse correction of the A, the B, the C, is you put the fib on from the B to the A, and it gives you a good indication of, you look at the 618, and again, it could come all the way to 272. If it was weak, it'd be the 414 or the 272, but it come all the way down here. It's another way to measure it. So why am I saying this? Is impulse wave, A, B, C. So now, you might get where I'm going now. Impulse wave, A, B, C. So for sure this inverse head and shoulders could be taking us up here, or we could be having, and this impulse completed this one here. So now this impulse here, A, B, C. So now let's have a look. And remember we did this a moment ago and we were looking at the 702 at 67.37, so it's a reasonable target. But let's say this is a peak here, and this is B, and this is A. And again, the 618 is back at 65.87, 66. The 414 is 67.23. So again, in and around the potential same space, yeah? So if this is an A, B, C down here, we've got to see what happens. So now, why am I saying this? Is because we're back in this position where there's your entry point, your dollar costed, it brings your entry point to here. You got this retrace, now you're in the red, you're in the red, you know, and again, your liquidation's all the way up here, yeah? You're coming down again, look, it's breaking down, here we go this time. Now you dollar cost in again, so now you're 300 in, and from here you come to there, and look, hits down. Now look, here's the retrace, and here it is coming back up again. So now you're back in the red again. And your liquidation is still up here. Your liquidation would still be up just sitting above, could be up above 86. Equally, you might go, listen, I just keep my liquidation above resistance here, keep it a little safer. So in case it does come up, that it's not costing as much. Okay, so you're being a bit more cautious here. But remember what I said, is it's coming up again. Okay, you've got 300 in it, it's coming up again. It looks like it's going to go. Here's your entry point. Well, before your entry point or a little bit after your entry point, $10 before, $10 after, doesn't really matter, is you take out some of your money. You got $300 in, take $200 out. Take $200 out before you go into the red. Now you're here with $100. Okay? You still have this position. You could say, but Roy, why don't I take it all out? Well, you could take it all out, and we don't know how far this is going to go. So again, you could be losing position. This could turn around and drop back down. So if you hold this position, and it wants to go up here, well, what would you do? What could you do? Well, as it peaks here, I could put back in $100. What would it do for your entry point? It would bring it back up to here. Let's say halfway. Bring it back up to here. So now there's your entry point back up. Now as it's coming back down, is actually there, you'll be back in the green again. As this comes into its correction, you're back in the green again. Okay? What you could do is what I was saying earlier on, minus not losing the $20, is price action. You've taken out you've got your here, and you've got your $100 in here. You're in the red a little bit here. Well, maybe you would lose a couple of dollars. You put $100 back in here. It brings your entry point back up, and then you take your $100 back out. So you're taking out 50% of your position. So when you were here, you were $20 in the red. Now you put $100 in, brought your position back up. Now take your $100 back out. Take 50% of your position out. It also means that if you're $20 in the red, you're gonna lose $10. Or if you're $40 in the red, you're gonna lose $20. But you've got a better position. And then price action, again, you're waiting for it to top out. You see it starting to retrace. You can see the potential 3, 4, 5 is it's part of the similar pattern that's already behaving. So okay, you've taken a $20 hit, and then now you know you have this impulse wave all the way back down. Or potentially is the 0, A, B, C. Because we're looking at this impulse correcting itself. Now maybe this is the correction. Coming down to 0.5 is the correction. That's very, very possible. That is very, very possible. Okay, so, but now when we were looking at this, it was also showing a lot of bearish divergence on the hour. This was showing bearish divergence. So what was happening is that you get the RSI, you see the price here and the price there. So the RSI was here. Now price action went up and the RSI came down. So when you see the RSI is here, the price action is here, RSI is here. Now then when price action goes up more, that last blow off top is when you know it's a blow off top. One of the ways you know it is because while price action goes up, the RSI comes down, which basically means that here's this final price action, but the momentum is gone. It's getting exhausted. So that it starts to move down. Now you see the RSI come down and price action will come down with it. So it's given a good indication that it's going to do a retrace. So now, by the time it gets down here, you're back in the green. Is you're making your $20 back, you know, and rather than waiting until it gets down here to turn green, you're back up here and it can turn green. So that's one of the ways that it could work for you. If it wanted to go higher, now if this wanted to go higher, you could do the same thing, and when you put your $100 in, it will pull your entry point. If this is up here, it'll pull your entry point up even higher, so that when it retraces, you're back in the green even sooner. Yeah. So you've got your dollar costing in. Your dollar costing in is if it starts to not look good for you, like where you're going, price action is changing, and it's like, Jesus, I'm going to go into the red soon. Is you can take money out of the margin. Let price action go where it wants to go, and then use that money you took out, put it in again, and you can move your entry point up. Is if you hesitate and it puts you in the red a little bit, is you can still do the same thing. You can take out a portion, you know, or you can, you can put in more, you know, immediately take it out, and as you do, you're taking out a percentage of a loss as well. So it might cost you $20. But you've moved your position. So it's very, very adaptable. It's very, very flexible. If you see it coming up and you think you're going to go into the red, well, take out as much as you feel you need to, let it do its thing, and then use that exact same amount to move your position. To me, this is genius. This is brilliant. This is brilliant because where your entry point starts doesn't mean that it's going to end up being there. You have the ability to move your entry point as it's going down. You can follow price action and load in. you know, is you can take a bit of profit. It turns around and starts going in the wrong direction. Is you can wait till price action gets up, put some more money in, and bring your entry point back up. You can be moving your entry point up and down as you need to. And there's a bit of a dance playing with price action. Okay, I'll give you another example. Another example of, of what you can do is, let's say, I'm going to look at this, yeah? There's your entry point there, okay? And drops down, okay, drops down. Let's say you do a dollar cost in there. Is it drops down here, okay? So now it drops down here. You take profit. You take 50% profit. You put in 100, you put in 100, you take out 50% profit, okay? Price action comes back up here again. Okay, great. Dollar cost in again. Dollar cost in here. There you go. Now again, it'll pull your entry point down a fair bit. But now look, you've got your 200 back in. You took profit here. It retraces. You put your 200 back in again. Now you've made profit on this. Now you're going to make profit on it again. And as it drops down, you take your profit again. So there are ways that you can dollar cost in, take profit, wait for it to retrace, and as it goes down, dollar cost in again, and take profit on both these drops. You can do that as well. So that it's very, very flexible. You can even do it here. Now on this is on the bigger trays, it's actually easier to do this because there's more movement. Let me show you here on the, like, here's the 1 hour, yeah. So this would be a better example of what I'm talking about. Is your entry point is here. Okay. Make that white so we can see it nice and clear. There we go. So there's your entry point. Excuse me. It drops down. And there your dollar cost in again here. You take profit here. Okay. You take profit here and your so let me change this. Okay, so entry point is drop, retrace, drop again, dollar cost in again. So now your entry point comes down to here. It drops down, you take profit. It comes back up, you start to see it drop down again, you dollar cost in again. Okay, you see it drop, and by the way, this dollar cost here will pull your entry point. It'll pull your entry point down closer. Okay, and you see it drop, it retraces, you dollar cost in again here. Okay, it comes down, you take profit. So now you've taken profit on this, now you're taking profit on this again. But when you've dollar costed here, it's going to pull your entry point to here. Okay, you're taking profit. It does its thing here. Okay, and then you're looking for a moment where you see it drop, you dollar cost in again. And this is 3 steps down, so 1, 2, 3. You can see that this is going to be the 3rd step. So quite possibly your dollar cost, especially because it's the last one, your dollar cost. Now this will pull your entry point and bring your entry point all the way to here, yeah? Somewhere here. And again, you take profit here. So on a bigger one, you've taken profit here, held position. It retraces. You're going to make profit again on the same space, same price action. You dollar cost in, you take your profit. Again, your impulse down, you look to take your profit. You still hold your position. You let it do its thing, because you know there's 3 steps down. This is the final one. So look, you're up here. Is your dollar costing. You do a couple of times more, it'll pull your entry point down lower, but that's fine because you know you're going to take profit here. So it's a nice way to double up on taking your profit and following price action all the way down. You could equally just start here, dollar cost, you know, there's a bounce, wait, dollar cost again, slowly but surely your price action is following down. There is a bounce again, patience, drops again, your dollar costing, and because you're doing it a little bit differently this way, you're gradually coming down, dollar cost, here's your entry point, even here's your entry point, and again you're looking to take your profit here. So that's another way you can do it. Now doing it that way is you're not holding, here's a resistance and a support line, is you're not looking to hold your position here on this one, is you're just dollar costing and following down. It's another way to do it. And on the bigger time frames, it's a great way to do it, because what you're doing is you're securing profit. And sometimes you're actually doubling up in the space that you're making the profit. So you're holding position, take profit. Dollar cost in, you're making profit in the same space. When it drops, take profit again. And it allows you to make double your money on the waves as it moves. So that's another way to do it. But this is on the bigger time frames. You wouldn't be able to do this so much on the 5 minute. And the 15 minute, again, it's a smaller space you're working in, so it's not as easy to do. So that is another way you can, how adaptable it is, which is what I'm trying to get across to you, how adaptable it is you can take out profits and then load in again. Is if you go in and price starts to go against you, if you start to see it going against you, you can take out, before it goes green or red, take out a portion of your investment and wait till it peaks. And an example here is and this happened. This is this one where we thought there was going to be an extra leg down. I thought there was going to be an extra leg down. Turns around and up it goes. So now an option to do here is to take out a large portion of, maybe take a little bit of a loss, take out a large portion of the entry, is let it find its way all the way up, and then your dollar cost, and if you're patient enough, your dollar cost is, it will pull your entry point way high. So if you put $100 in here and you've got this big movement, if you put $200 in on top, is $100 will take you halfway. If you put in $200, it takes you up much further. So what you're doing is you're playing the position, you're waiting for it to turn green, and you're back in the green, and there you can go. Now it's not favorable. I'm not selling this as a, yeah, listen, that's an option, you should do that. What I'm saying is that if you found yourself in a position where you find yourself getting into a hole, is you can dollar cost and use your margin, and you can from your starting point, just as an example, you went on a short at 65. Excuse me. Is you can put money in the margin, dollar cost, also put money in the margin, and you can stretch your liquidation to half of your position. So at 65, what was this? 65 here, is half of that is 30, what is it, 32? Let's say 32. 32 onto 65 is 90, 97. So if you put $100 in here, is with margin, you could bring your liquidation price all the way up to 97. Where is it? 97. Okay. Now that's just with putting money in the margin. So what money in the margin means is that it's allowing you to move your liquidation price, but it's not more money in your trade. So it's not you're putting money into trade, you're putting money in to move your liquidation point. Is you can do that as well, yeah? And up to 50%. You can make that go further is if you dollar cost. So look, I'm at 65. If I dollar costed and dollar costed and dollar costed as it was going up, so that my entry point was 65, but by the time I finished dollar costing, it pulled my there we go. It pulled my entry point up to 78. So now I have 50% of 78. So now 50%, let's say 80, just to keep it simple, is 80. I got my entry point up to 80. Is I could add on another 40. I could add on another 40 and put my liquidation up to 120. Okay? And that gives me lots of space. So I'm not saying it's favorable. I'm not saying that, yeah, do that, because again, there's risks in it. There's high risks and it can be expensive. But what I'm trying to show to you is the adaptability of dollar costing and using the margin. There is a huge amount of adaptability. And price action over a year is, if you think about, you get lots of price actions that move in one direction before it changes direction and does a retrace. So what I mean is that you're going to get an awful lot of 5% moves that retrace back. So in one movement, it does 5% and then it retraces. It either comes a portion of the way back or it comes all the way back and goes in the opposite direction. You have loads of 5%. You'll have lots of 10%, but you'll have fewer 15%. So the amount of times that price action will move 15% before it goes in the opposite direction is a percentage before it comes back in the opposite direction. So there's less 15%. There's even less 20%. There's less 35%. There's a handful of 50%ers. There's 60%, some a year, is maybe once or twice a year, is maybe even say even 6 times a year, is it does 75%. 70 in one go. So when you start to look at the amount of times a year that price action would move, say 40% before it doing a retrace, you might get one a month. Some months you wouldn't get it for a bunch of months. Some months you might get it 3 times in the month. So price action can from one position go 50%. If you dollar cost in, you can get that up to 60, 70%. So if you applied that, not that you would want to, but if you had to, you can apply that, and the vast majority of situations that you find yourself in is price action will return and come back to a position where you find yourself in the green again, and then actually making a decent profit on it. One of the challenges is time. It might take time. So you can get caught in the trade and it's taking you time to get out of it, you know. That can be a nuisance. Equally, it means that there needs to be very few trades that you lose. There's nothing to stop you trading on 2 accounts. So if one is in this position, you can trade your way out of it. You know, if it takes time, you can trade on the other account. Again, I'm not saying this is a good thing to happen, but it allows you that adaptability. Because I have an account that I put my longs in, I have an account that I put my shorts in. If those two accounts are busy, I have a third account that I can put longer trades in. So I have different accounts to suit the different types of trades that I want to do. Yeah. So it's very, 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 very adaptable. Not the best, again, not the best of situations, but it demonstrates how adaptable it is. Is in this position here, is doing it, bringing that up 60, 70% up here is not such a good idea because price action is due to break up soon. So you don't want to get caught in that. Okay, but let's say here, let's say we're at 70, 76, 77, whatever it is, price action. It would be easier to apply the same process here because price action is less likely to come down as far because it is very close to its bottom anyway, if it hasn't already hit its bottom. So that same process here is less risky because the likelihood of it coming down is less likely. Now think about it when it turns into the bull run. And I talked about this the other day, is the bull run when it goes, is the trend is up. Okay? The trend is up. And it'll go on for a month or two. Might go on for longer. So this is the daily. Here's anywhere we can take a position. But what I'm going to point out to you is the retrace. Let's say you took an entry point somewhere here and it retraced. Even here, you went right in here and it just turned and went down. What's the worst case scenario here? 28%. One day, 28%. The next day, back up. Down, up, and then up. So you wouldn't be in it for very long. You could easily dollar cost your way if you went in the wrong position. You could easily dollar cost your way to bring your entry point down, and you could easily dollar cost 28% and far more than that if you needed to, but you don't. 28 is the limit here. Let's say here you went in here and it retraced. Okay, because you can't count these because if you go in here, it'll go all the way up here. So this is the one where if you went here and it dropped 13%. Is 13%. Let's say you went in here going for a long and this happened. %. I went all the way back up. You get out breaking even, and there you go. So now you can see how dollar costing on the way up is brilliant. It also gives you the ability to have a deep stop loss or liquidation. And if you had a liquidation of 40%, you'd never get knocked out. You wouldn't lose a trade on the way up here. You might have to be patient for a day, and then up it goes. And when you see it's confirmed, again, load in, load in, load in, load in. Equally on the way down, look, it's reaching a peak, it's going to turn. Is your dollar cost in, and you work your way down. Do the same thing all the way down. But I'm going to do the same thing here is, let's say you went in here, and you got this big retrace. Well then, the retrace here is 32%. This one here is 32%. Give it a day, 2 days, and it's heading back down again. So you get what I'm trying to say is that on the way up is you can have a deep stop loss here on dollar cost, and you'll never get caught. On the way down, again, your dollar costing or your stop loss is up here, and you're just letting price action go down. You're catching the swings, do the same thing here. Here, again, you're swing trading, and is more dynamic. Okay, and in some ways, this would actually be more challenging because it would be harder to read, because always the first wave up always has a nice deep bounce, and then here's another one, and then it goes sideways before you get this big spill here. So now I'm really looking forward to when the bull trend comes in, because it's going to be far easier to actually trade. And we can do our longs, and then sometimes, if it's appropriate, we can do a short. But now the short is, I would go in a short here. Here's a peak. I'd go in on a short here, and I'd put my stop loss just above the peak here. I wouldn't take the same risk. I'd put it just above here, and then let it do its thing. So I'd be in my longs, and then I would catch some shorts on the way down. Again, I'd want to be checking for the sideways, and you'd see things getting exhausted. You know there's going to be a bit of space. It needs to reset itself a little bit. So we'd be TAing that as we go along, yeah. So there are some of the ways that the dollar costing is very, very flexible. I got far more familiar with this when I started to use small amounts of money, because it gave me the courage and the confidence to test all this, to go in and go, if I did this and I did that, how did that go, and what's my percentages, and you know, what type of movement do I get, and when does it work for me, when does it not work for me? When the money risk of it is low, it gives me the freedom to explore the adaptability of dollar costing. I would never have figured this out if I'm loading in and I'm in a sweat because, you know, I'm putting in big money, and the stress of it is just more difficult to deal with than anything. So on these times when it's tricky and the trading is difficult to do, there are other ways we can develop here. There's other ways we can learn. We're setting ourselves up to be better traders by being able to trade these tricky times, being able to get in on a trade, live in the trade, as in play the trade, you know, and play until the position gets right for us. And when the position is right, then we go with it, and we catch our win. It's an excellent way to develop as a trader, and it will stand to you, because when it's easy, it's easy. When you have the confidence of the DCA at the same time, it gives you a great confidence to stay in trades. It goes a bit red. You can trade your way out of it, and then see when your position changes. Now you start loading in. Now you take your profit here. Let it retrace a little bit. Okay, now load in again. Take your profit, and then just let your entry point follow its way up. If you get too close, Icarus, you get too close to the sun, you get a retrace. It's okay. Well, then reduce your money in it. Let it drop, and then dollar cost follow backwards. Follow it backwards. And when you see it turning, okay, there's the turn, okay, and then you switch your dollar cost back up again. So super adaptable. It just takes practice, patience, and just getting used to learning how to trade within the trade. So it's not what you start with. Is you can live in the trade. You can trade your way into better positions within the trade itself. So, has anybody any questions?
So I see that it's nice to do the DCA, but it's still challenging when you're in the trade. Like, let's say, for example, right now,
Yeah.
It's looking to be like 77.15. It's a nice DCA point,
Yeah.
but it's still in the mindset that, as you just said, it could be a breakout.
Yes.
And if it does have a breakout, then we might be heading towards the dollar. You don't have enough to DCA in, like you would need in order to keep your balance on.
Yeah.
You need to put a lot of money.
Yeah. Yeah,
And
Farouk.
then,
Yeah,
yeah,
in this situation, you're absolutely right. So, in this situation, I wouldn't be doing a big. I wouldn't be willing to DCA on the too high on the short here. So I would look at it and go, look, if I put in whatever amount of money it is, a small amount, is I would look at keeping my liquidation or stop loss about above 85, 86. If I see it breaking 85, 86, is I reckon that's it, it's going up. So I would identify what's the limit that I think is the real breakout. If it breaks this, it's definitely looking like it's going to go. Is then I would look at where's my entry point, how much can I put into this, and put my liquidation on my stop loss at 86, and it's not a big risk to me. It's not going to cost me an arm and a leg. It's going to be a small amount, and that's how I would measure that risk, Farouk. Do you understand?
mhm. Yeah,
You know, and sometimes the trade is to make profit, and sometimes the trade for me is to learn how to trade this, is to put myself in this circumstance and then see how it goes. Let's see how I can trade this position. If it goes my way, great. I can load in if it's going my way. If it's not going my way, I'll be flexible as much as I can. But in the situation you're presenting, it's too risky to be trying to play the high dollar cost position here, because we really are. I think we really are close to switching properly to the bull trend. You know,
mhm.
or Farouk, you know, it's frustrating. We could end up being another month or two in the doldrums here, but it's just.
I'm hoping not.
Me too, me too. But it just seems to be dragging on and on and on and on and on and on. So I've stopped trying to guess exactly when it's going to turn, because um, it'll do it when it does it. You know.
Like I only started trading back in end of October or something like that.
Yeah.
So last month is a big challenge. Like
Oh, it has.
we
Yeah.
had some slow times and stuff like that. I didn't mind them,
Yeah.
but the last month it's like a big challenge.
It is, and I'm glad you're saying that, because it's important. It's important that you guys know it is a really tricky time to trade. You get an awful lot of people on servers now who they back off. They won't trade. You know, or they'll get stung a little bit a couple of times, and they'll just go, okay, I'll wait till price action settles and decides on its new trend, because it's just too tricky. And I can understand why people would do that, but then it also tells me they're missing an enormous opportunity to become a far better trader. You know, so the playing the low money and really learning the skills. This is fun. It's a fun time to trade if you're not risking the house, so to speak. You know,
Yeah,
so
it's quite addictive as well.
it is, to be honest. Yeah, for me,
I tried to step out. I couldn't. Like I said, no, I can't leave it alone. Like let me risk a little bit of money. That's okay.
yeah,
And if I lose it, I lose it. I would try to make more out of it, but it's still not going to break the bank.
yeah,
But yeah,
yeah. Like I personally, I love strategy. I love strategy games. I always have, and this is all, like, trading is all strategy. You know, once you get your TA, and you're comfortable with your TA, and you're triple checking it, it's all about strategy after that. Is having the right strategy, having the most adaptable one. That's why I think dollar costing. I know an awful lot of people don't have the patience for dollar costing, because of a couple of reasons. One is they don't think it makes them enough money quick enough. And then two, it requires more attention in the trade. You can't just put in a trade and sort of look at it and, you know, collect your profit at the end. And dollar costing is you have to TA your way through the trade, so it's more intensive. But I'm just thinking, is it, if a person has the intention to make a real livelihood out of this, to make it a real career choice and true financial freedom is dollar costing is the way to go. I would imagine the vast majority of, and it's what the market makers do, I'd imagine the vast majority of professional traders who are doing it for a living, they are all dollar costing. Very few of them, if any, are loading up. That's what amateurs do. That's what people who don't know what they're doing is they load up, you know, they roll the dice and hopefully it goes their way, and you know they'll use their stop losses as protection until the stop loss hammers them. You know, as you get one or two stop losses, you go, okay, that's painful, but you get 8 stop losses out of 10, and you're in a deep loss. There's not enough wins to make up all those stop losses. Where dollar costing is it gives you so much more adaptability that there's an awful lot of trades that your stop loss will knock you out of. Dollar costing in and being adaptable stops all that, but it requires more commitment and more engagement. But if your intention is to be a successful trader and to make a real livelihood out of it, well, then why wouldn't you put the time and energy into doing it this way? It's the long game. You want to do this in 10 years' time, dollar costing will keep you in as long as you want. Loading up is only a matter of time before you're going to get caught. So, again, you know, if I sound like I'm preaching to myself because I've made all those mistakes. You know, I made them all. So yeah. Anyway, so in my own personal journey, it's just the value of it for me is it changed everything when I started dollar costing. It changed my success rate. It changed my state of mind. It changed the stress levels with which I trade with generally. You know, it's just very different. So
normally, how many dollar costs you keep in mind when you're entering a trade? Like, let's say you're putting in a trade right now, like the one we have in here.
Yeah.
Like, what's your limit that you will be putting a dollar cost in? 3 times, 4 times?
Yeah, absolutely. Yeah, like the trades I'm in now, they're on the 5 minute because of the space we're moving in. You know, so there's not a huge amount of space for DCAing. So if I can get in 3 times, I'd be delighted. I lost it there. If I can get in 3 times. If I can get in 3 times, I'd be delighted. You know, twice in these situations will be good, but 3 times will be better. You know.
Yeah.
In and around that generally, you know. So.
Well, like you normally like budget, like let's say, I'm going in this trade, let's say for $1,000 in total. So I'm going to put $100 in right now.
Yeah.
And then that will allow me to probably dollar cost in another 4 times so that I can double up. Yeah. Between 3 and 4 times.
Yeah. Well, I'm mindful in the tightness of price action here is dollar costing in 4 times. You're going to lose your position. So you've got the range of your resistance and your support. Is if you dollar cost in too much, it's going to pull you out of your position too much. If that makes sense.
Yeah.
So just you gotta be a little cautious with that, you know.
All right.
So
are you following the price action right now?
I'm looking at it there. I am looking at it there again. This is now there is. I'll show you now.
We are missing a screen. Your screen is not visible.
Oh, sorry. Okay.
No worries.
Yeah. I'll share it now. Hang on. Bear with me for a sec. There we go. There we go. Yeah, so here is I think my pull-out point on this, my pull-out point in this will be Mountain Peak. Is if price action starts moving above, it's getting close. See 80. If price action starts testing the 80 mark or moving above that too much, I think that's time for me to pull out, so to speak. You know, I have an entry point at 78. So it's not too far away from my entry point. But because of the nature of this could break out and start pumping proper, is I'm not willing to step into that, you know. But look at this go. Look at this go. 78.90. Let's have a look at the fibs. I'll pull the fibs into this one and just have a quick look. Or not the fibs, the MAs. Okay, so what's doing all this pumping here? What time is it? 10. Okay, so there's the 10 there. Okay, so it's coming up to the Bollinger Band on the 10 hour. And there's the can you see my screen?
Yep.
Okay. So there's the Bollinger Band. I was trying to look and see where, like, where's the, is there a limit to this? Is there something that it's gonna, here's the 12 hour. Okay, so look, there's the 12 hour. There's the 200 MA on the 12 hour. And the dark one is the 200. There's the Bollinger, and then the lighter red one there, that's the 200 EMA. So it's quite possible that that could put a stop to it. You know, it could put a stop to it and put a retrace on it. Like if you look at the pump here, it could put a retrace. It could put a retrace on it. But yeah, look, it's breaking out of this channel. But now it spiked out of it once before. Spiked out there. Yeah. Looking at this line here, for it to go down for continuation, it would definitely need to break this line. So the question is are we going to have one of these? I don't know. It looks like it wants to go, doesn't it? Here's
looks like similar to the last ones that we had. It just like goes up really quick when it's pumping, and whenever it's going down, it doesn't go that far.
Yeah, absolutely, yeah. Well, again, I think that's part of the transition from the bulls to the bears. Is the volume is starting to appear, so you're getting these big volume pumps, and then you can see that it's the later, you can see the MAs here on the daily. Like there's the 100 at 80.25. There's the 144 at 81.46. These are the guys that are on the daily now that are pushing down, because when you go to the 4 hour, look, pretty much all the MAs are below except for the 800 up here. Is if we go to the 12. Okay, we've got the 200 and the 800. That's on the 12 hour. So you got to really start going to the 12 hour and into the dailies before you're finding moving averages above price action. So what am I basically saying? Is all the minutes and the hours up to the 12 hour is you have the moving averages below price action, which means it's going to pump up. So short term, there's a lot of pressure for those guys to pump up. But then when you start going above the 12 hour on the day, the 2 day, the 3 day, is you have these guys coming down, you know, and if you look at the battle going on the days, some of the moving averages are underneath, and then some of them are on top. So you can see the way the pendulum is swinging is that the minutes and the hours are underneath, is some of the days are underneath and some are coming down, and you're getting this tight action going on here. Is actually, this is the 2 weekly, excuse me, this is the 2 weekly, is even the weeklies, you can see that there's that transition going on. If I go to the 5 day, I'm just picking some out just to give you an example, yeah, is look at the 5 day, is look at most of the moving averages now, look how they're all starting to bunch up. So here on the 5 day is price actions after spiking up to the 20 MA. Is if this continues on a little bit more, is the 20 is going to get below. Is the 20 get below and the 20 starts to turn up, is what's happening is that, and look at the way the moving averages are coming down here, is the minutes and the hours are underneath, more and more the days are getting underneath, is some of the weeklies are underneath, but then some of the weeklies are coming down strong and heavy. So that is, it's looking like it's going to break up, it's looking like it's going to break up, and then something comes down and then just knocks it down. It's like, here's the 50 on the 5 day rejected this here. As you can see, the 20 on the 5 day is pushing down, but the 20 is very close to getting underneath, you know. And then here's the 50 here. Is let's look at what the week is doing. Okay, so the week is, look at the 20 here is part of that rejection. Look at the 20 EMA and the 55 are part of the rejection here. So you can see that on the weekly is you got these guys coming down. So you got the bounce down, and look what's catching it, the 100, the pi 111 here, the Bollinger are catching it. Is you're getting this support and resistance going on, and this is on the weekly. So now look, we got this big rejection candle on the weekly, is, but again, look, we got a big rejection candle here on the weekly here. So look, big rejection coming down, big rejection coming up. Is how far is this going to get before is we get another bounce down? I don't know. Is it took, what, where are we now? We're on Monday? This Monday? Look at this. So this was last week, and this is today. This is today. Okay. So what do you think that tells us about price action? Do you think this is telling us for the rest of the week it's going to start to head up? Looks like it, doesn't it? What do you think? So this was the rejection from last week. Sunday, Monday, a little dip, and then up it comes. So all this has happened today. Here's the RSI for the week. As I look at this, this seems to indicate, but now watch this, is, do you see the wave? See the peak, the bottom? Is the question is how much will this peak again before we get and in the week you can get a touch, and then it can resist back down. Is by the end of this week, is I think the max is this could possibly go to, without a proper breakup, is there's the 55 at 81.31, and again we might get a day where we get a resist back down. Is there's the 20 at 82.76, and then potentially a strong rejection here at 87.03. A strong rejection here at 87.03, and I'm back for potential another up or down. I don't know. What do people think? now that we look at it. Let's see what
Very hard to tell.
it is, isn't it? But it does sort of look. Now there's the 6 day, yeah. So there's the rejection, and here's the lift up here, yeah. So, and that's going to change on the 2nd of March. So let's do the 5 day. 5 day again, rejection up today. Look, it looks like this could be peaking out at the moment anyway, at the 20. It's rejecting it at the moment. Let's have a look at the 4 day. There's the rejection. Come all the way down here, came back up. Okay, and the 20 seems to be holding it there. 20 EMA at 79 pretty much. Let's do the 3 day. Again, the rejection. Back down, back up. Came down to about the 200, back up here. There's no EMA or MA here. And again, you can see on the 2 day, the support is the 20, and then the resistance is the 50. Okay, so now this will be a little bit more telling to something more local. And what I mean by that is that this changed today, and 28, and this is going to go on for today and tomorrow. So now it did a pump from the 20. It did a pump to the 50. There's a rejection here. It's a bit like the Bollingers. Is potentially, if this is the limit on and the 50 is now rejecting it, that's an indication that for the second half of this 2 day, which is tomorrow, we could be looking at the 50 now rejecting and pushing back down. That's a possibility. It's doing it a little bit at the moment. The question is, will it continue, and is it strong enough? So now if we go to the day, okay, we zoom in a little bit more here. Is the 50 on the day was the support here. Gave it a good punch up today. There is the 20. If it doesn't reach the 100 MA here at 80.42, you got the spike through, and what really is holding it in place is the 20 here. So if the 20 holds this in place, will it be tomorrow be a rejection and a push back down, or are we heading for another pump, a proper breakout? It's hard to tell. I don't know. There's just too many twists and turns. So now I'm at the 12 hour here. So now look at the 12 hour today. The second half of the day was this. Look at the first half of the day, it was a lot more somber. So there's the support. This push down was from last night. Look, a real solid push down. Tried the breakthrough again today, couldn't make it. First half of the day was down, but very sideways. But then the second half, that's when it turned and it pumped. And it's come all the way from the Bollinger here, and the Bollinger up here is at, and there's the 200, is at 80.34. And it's quite possible that price action doesn't want to break this, because this is mountain peak. And there's the Bollinger there. So if price action doesn't break this, it's telling me that this is a peak and that there's going to be a return. If it breaks above mountain peak, again, it still has to get past this. But if it doesn't get above this, if it stays below this, it's telling me that price action doesn't want to break this, so therefore we're in for a turn and a retrace after that. And we'll see. We'll see. So look, here's the impulse up. Put the fib on it. I know I did this earlier, but let's do it in the 12 hour. So here's the triangle. Here it is breaking out, spiking up like it did there. After it did this, it retraced back and then came down and to the bottom here. So now, and then it bottomed out here again. So you can see there's two lines here, and these two lines are long-term support lines. They're not just locally to here. These are actually long-term support lines. But equally, you got this triangulation coming down here. So if this is a rejection, doesn't want to break this, and it is a rejection, it comes back in, we could be looking at it coming back down to the 618, the fib here. Again, back at 60, 67, 50 or so, thereabouts, is coming down here and touching this. If it really wanted to do something a bit deeper, it'd come down onto this line. There's the Bollinger there, or back to the 786, down at 65. So, yeah, it's, I don't know. I honestly don't know. But there you go. It'll be interesting. The VWAP is going to turn at 12 o'clock. So I've been talking a lot about this lately because it really makes the difference. So how can it make the difference here? Is when the VWAP turns at 12 o'clock, and this is the last thing I'll say, and then we'll sort of wind it up. Yeah. If I go to the 1 hour, it lets us see it, I think, more clearly. Yeah. So look, there's the VWAP. You see that straight line? You know, there's the VWAP. You can always tell when it's 12 o'clock. Because price action, VWAP goes straight to it, wherever it is, and it resets. There's another one. So the VWAP resets. So now is when the VWAP resets, is, look at here. It came up, it became resistance, pushed it down. Then it became support, a little bit of resistance. There was a 12 o'clock there. So look, it came down here, and look, it held it as support until it broke up. So now the question is, you've got the VWAP here, the yellow one, it is 22.52 in 70 minutes. This VWAP is going to shoot up to where price action is, exactly to where it is. And again, when VWAP shoots up, will it do this again? Will the VWAP become resistance and give us that pull down? Will it give us our pull down to 67? Will it facilitate? Again, here we are. This impulse here, will it facilitate it? Bringing it back down to the golden pocket, 702, 67.50 or so, 786. If we treated this as an impulse, and then this is the A and the B, and we put this on it here, and the 1618 is 64.80. The 144 is the 66.50. So again, there's a target that it can be brought back down to, but only if price action doesn't break this. Okay, if it breaks it, then this is not the impulse. I would suggest that this impulse, and then this is the correction, and it's done, and this is a new impulse. So if this doesn't break it, this can be the A, B, C. Okay, so I think it's quite important that in these local terms that this doesn't break above 79.88. So let's see what happens. Let's see what happens. So any other thoughts or questions while we're here? No? Okay, guys. Listen, enjoy the rest of your day or your evening, and let's see what happens here now. And let's keep learning and growing with the trading. Trade safe. proper risk management. And as soon as it turns again, I'll let you know as it's changing, and we'll all see it. You're going to see the pump. You're going to see the trading strategy be adapted for the pump. And one of the things we'll be looking for is a nice sweet entry point, and then knowing the dollar costing and the stop loss liquidation point. And if we're getting it right, is we should be in a position where once it really starts to go, is we can just follow it up. And we can just keep loading in, taking profit, loading in, taking profit. And I'll talk you all the way through it as we're going along, yeah? But for now, enjoy the rest of your day. And
Thank you.
I'll see you later. Yep.
Roy, before I let you go, I have a question. Since I don't know which direction it could be going from here, is it safe to open like a long position from here, just in case if it's pumping, and still keeping my short, or is that too risky at this point of time?
Yeah. I was looking to do a long at 67.50, and I was a little bit cautious. I actually decided not to do it simply because I don't know how this whole thing with Russia and their banks being taken off SWIFT, and I don't know what that's going to do to the market. I thought there was going to be a bit more volatility today with regards to dump. There still might be, but it's Farouk, I don't know at the moment. That's the honest truth. I've pulled back from that, and again, I don't like missing the opportunity of getting in on a good long, you know. But my decision that I've decided is I want to see. I believe there is still a retrace left here, some form of retrace, whether it's it comes back down a small amount or wants to go further. I want to see what the retrace is, before I go in on a long, you know. And it's already done a big impulse there, so it's like, I know when volume comes in, it pumps and it pumps and it pumps, and we're not looking for a retrace anytime soon. But those type of volumes and pumps, when they come, you know them. They're there, and they're going hell for leather. At the moment, this is not it. This is not it. So the volume here is it's oversold in the RSI. It's looking tired and exhausted. It looks like it needs to do a retrace. I could be wrong, but I think there's going to be a retrace. So personally, I'm going to wait to see what the retrace is, and then potentially put a little bit in.
No, you're right in that.
Yeah. But we don't. I know you don't. We don't want to miss the boat on the pump, you know. But again, I would say to you, same strategy, Farouk, is if it's a real pump, we'll know it. Even if we're a little bit late in it, is getting in a position, a small amount, and then pulling the stop loss or the liquidation point, bit of margin, pull it down 20-30%, is even when something pumps, it does these big retraces while it's pumping. You get these big candles that go up and down all the time, yeah? And it's knocking people out of their stop losses. Is if it pumps, we can pull our margin, a small position, pull our margin away, let ourselves get position, and then let it pump, and then when it starts going our way, we can dollar cost in some more. So we don't need to miss the pump, even if we don't get in on it straight away. You get it? So yeah. There you go. Very good.
Thank you.
You're very welcome. Farouk, thank you very much. Have a great day.